Hi, I'm Joe Cavatoni from the World Gold Council, and I'm responsible for the Americas business for the firm. I'm joined today by Bob Haber, founder, partner, and chief investment officer of Proficio Capital Partners. Bob leads Proficio's investment committee, splitting his time on both public and private investment solutions, and manages Proficio's research team. Previously, Bob spent more than 25 years with Fidelity, culminating his role as CIO of Fidelity Investment Canada. He is part owner of the Boston Celtics basketball team and a member of its board of directors. It's great to have you here today with us, Bob. Thanks for joining.
Thank you, Joe. Thank you. Great to join you.
I'd like to get started by actually taking a quote from a recent Forbes article, and I'm going to quote something that you've said, because I think it's really timely and actually very important as we kind of set off on our discussion today. And the quote is, "The role of any asset allocator is to help reduce volatility while sacrificing as little return as possible from the best asset class," which has historically been equities. Less volatility means more sleepful nights, fewer large drawdowns, and happier investors. Let me simply ask you, how do you go about at Proficio implementing against that kind of mindset and that kind of approach to the investment markets?
Yeah, well, I appreciate that. And I've been doing balanced investing for a long, long time. As you suggested, really, I started at it in 1985 with Fidelity. The goal for us is that we would like to make competitive returns. In our sense, we'd like to beat inflation by 400 or 500 basis points a year from our investments. But most importantly for our families, we want to do that where we get a very high return relative to the risk we take. We view the world as having four asset classes, one of which is equities, one of which is investment grade bonds, one of which is gold, and one of which is cash. And I can go into how we do that and whatnot, but what we try and do is get a forward estimate of where we think each of those asset classes will be for the next 10 years. We understand the relationship, the way these assets trade in a portfolio together. We look at some statistical models to tell us how do they react to each other. And then we find what we call an optimal mix. Obviously, we add humans in there to make sure that we're doing something that makes sense for the current fundamental times. And we set the allocation and we invest to it.
Fantastic. That's a really interesting approach. And actually, one of the biggest topics that we've been hearing from our clients, and the reason that gold, as an example, and you've called that out as a specific asset class that you focus on, has been really concerns and questions around what does the future look like, particularly as it relates to inflation. You know, we've recently put out our study, which talks to the fact that gold, while it might be a laggard in early moments of inflation, often performs well over the longer term, particularly at inflation levels of 2 or 3%. In addition, it fundamentally performs well as part of a basket of real assets. And it sounds as if that's something that you and your firm gravitate to as well.
Absolutely. So we do forward projections, as I suggested, for each of these asset classes. At the moment, our 10-year forward projection among those four asset classes, equities, bonds, gold, and cash, is that gold will be by far the best asset class for the next decade. And then we check that against historical context, as you suggest, and then we look at the current fundamentals. And key to that for gold is that currently we believe both the Federal Reserve and the federal government are not concerned with inflation. And so when that occurs, we worry that they're not concerned really with using the currency as a store of value. And so given our 3,000-year history with gold, so to speak, we're comfortable, even though we focus on the last 50 years of data, that gold will keep its place as that alternative currency during this period where the fiat currency is not doing the job of a good store of wealth.
How much of your client interactions today, you manage a lot of money in family office format, how much of your conversation with them is about where we are currently in the environment coming out of COVID in terms of one of the most unpredictable, very challenging investment environments? how much are you spending in terms of talking with them about short-term opportunities versus risks versus more staying true to the longer term in terms of a strategic allocation and your model that you worked on?
Yeah, so we while we have that strategic allocation, as I mentioned, we tactically move around it, trying to create alpha in each of those four buckets. And we're in constant contact with our families, talking to them about both short-term things we might be doing and big longer-term issues. And like inflation, is it real? Capital gains taxes, are they going up now more permanently? And where are we in the economic cycle? So we hope to over communicate so that our families can feel that we're very serious about watching their money and making sure they get a good risk adjusted rate of return.
In terms of the currency bucket that you make reference to, do you have alternatives as well as gold in that bucket?
Yes. So there are different parts of the economic cycle. The part we've come through recently, which we'll call reflation, boom, whatever you want to call it. So that's kind of starting late last year. It became more obvious, or middle of last year to late last year, it became more obvious we were going to get through the COVID and we were going to go through an economic boom, fueled, one, by people getting healthier and more confident, but also by huge stimulus. And
right.
During those periods, historically, we have favored things like silver and platinum, which are very closely correlated with gold, but they tend to do better because of their industrial uses. And our other alternative is to be short the US dollar, which we are as well. The economic phase can shift, and we might then move all of our allocation back to gold. We still have a core of gold, but we've branched out in things that we think will add alpha to gold.
That's interesting. That's a very interesting approach. You know, we've been getting a significant number of questions from our clients around the potential for our commodity super cycle. We've written pieces recently which we talked about how silver, copper, other commodities will likely perform even better on the shorter term and quicker as a result of the stimulus coming to life, the economy's coming back online, but gold will definitely perform well in that cycle as well, but as a laggard. It's interesting to hear that you look at those other elements and those other components as you build out your basket. Do you take into consideration equities to represent that currency basket or that gold exposure as well?
In that basket, we will use exclusively gold miners or silver miners. You referred to industrial metals. We invest in those as well, but we consider those in the equity bucket, the non-gold stock bucket. And they do act differently historically. I think they're both going to work because it feels as if we're headed to a higher level of inflation, and gold works there, as do industrial commodities, and in this case now agricultural commodities as well. But in our view of the world, they're different assets, and we treat them differently. Interesting.
Bob, one thing that constantly comes to mind when we speak with our clients, and actually we get this regularly globally, it's not only a U.S. phenomenon, is the conversation around the right kind of diversification in a basket and correlations. Any thoughts on how your four categories of investments and anything that you want to share with us in terms of correlations with respect to that?
Yeah, so we're constantly monitoring through we'll call it covariance tables, how these assets are interacting with each other. And we take a 50-year view and we take a 5-year view, and we use the data to tell us, are these correlations changing? And we weight them in a proprietary method. That's important to us because, as I mentioned, we're looking for what's known as the efficient frontier, where we're getting return without taking additional risk. And so the correlation part, the math part, is very important. Fortunately, the 50-year relationships, they change obviously in a quarter or even a year, but over some decent investment period, they tend to be reasonably stable.